Hello, everybody. I am Toby Shifsky. I am Vice President of Real Estate Education at Kaplan Real Estate Education. And today we're here for our Real Experts webinar where we bring you all the hot topics and current going on in real estate. And today, kind of a big day for us as we prepare for our taxes on April 15th. And today, our special guest is Michael Angell. Michael, thank you for being here.
Thank you, Toby. It's wonderful to be here.
Yeah, and if you don't know Michael, I can give you a little background on Michael. Michael began his financial services career in banking. Was it more than 20 years ago, Michael? I think it was more than 20 years ago. I think we get to a point where you say more than 20 years as opposed to how many years exactly. I get it. And eventually, Michael, you migrated into, I think, investment management and insurance planning. And he has served clients in various capacities with independent boutique-style firms and learned directly from seasoned CFP practitioners in the field. And Michael has also been an income tax professional for several years. Michael obtained his Master's of Science in Personal Finance Planning degree from the College of Financial Planning. He is a certified financial planner practitioner and enrolled agent authorized to practice before the IRS. Michael, thank you for being here.
My pleasure.
Absolutely. And just full disclosure, so anybody knows, Michael is with a Kaplan company. I don't know if you know this, but Kaplan does own a college, and it owns the College for Financial Planning based out of Colorado, and does a number of different certifications in the financial planning field, along with a master's degree in science of personal financial planning. Michael, looks like you very much took advantage of that program. And now you actually do some teaching for us, don't you? For the College for Financial Planning too.
I do.
Absolutely. All right. Well, let's do this, everybody. Today, we're going to do tax tips for real estate professionals, how to maximize your deductions. And Michael's going to be the guy who's going to be able to answer a lot of questions for us. Once again, I'm going to play the role of the questioning. Everybody, you have your chat window that you can throw your chat in. We've got Jamie Cash on here also helping us, Michael. Jamie Cash runs our community forums, everybody. You're going to have a chance to continue this conversation after the webinar if you want in our community forum. Michael also has access to our community forum. He's one of the experts on there, can answer some of these questions for you guys too. So once again, use the chat to answer some questions. I'm also going to ask some poll questions of everybody to get you guys all to kind of start playing along with us. And as a matter of fact, let's go ahead and start with a quick poll question. Michael, we get a lot of people on here who've got 10, 20, 30 years of experience. Some of them are fresh. They're still in education right now, which is, I give them a ton of credit for being here and being a part of this because they're already getting fed, knowledge through a fire hose, and they're here for a little bit more. So let me ask the poll question. Poll question number one, and just to remind everybody, poll question number one is how long have you had your real estate license? Well, how about this? You're currently taking classes or less than 3 years, 3 to 5 years, 5 to 10, 10 plus years. We'd really like to know who's in here because we'll kind of gauge the conversation towards who's in the session with us today. That's kind of one of the advantages of being here live is not only can you ask your questions directly, but you also get to influence kind of the topics that we're covering. So I'm going to go ahead and if you're on your phone, you might have to swing to the next, you must have to slide over to get to the poll, but you should have a poll question up on your screen. I know some people have dropped their answer into the chat. Try to use the poll if you can. I will always share the poll results. I'm going to end the poll now, and I'm going to share the results. Take a look at this. 34% currently taking classes. Less than 3 years, 28%. 3 to 5 years, we got 9% of you. And 3 to 5, you guys came in right at the beginning of COVID. That's super interesting. I think, Michael, there's some super interesting things that happens with COVID and the entire class of professionals that we're seeing in the industry right now that are quick adopters, quick movers, super interesting group set of people. And then 10 plus, 5 to 10 years, 4%, 10 plus years, 16% of the people on here are going to have some pretty good questions. By the way, if you're a grizzled, wizened veteran, you play along too in the chat. Just remember, everybody, in the chat, we see your name. In the poll questions, those are anonymous. We don't see your name in the poll question. So be as honest as you can in the poll questions, and I think it'll make a better experience for everybody. All right. So let's do this. I am going to stop sharing, and I'm going to start asking our esteemed guest, Michael, to help us out. Because I know as a new agent, myself in real estate, I really didn't know a lot about taxes. And I thought I knew a lot about taxes, but I had no idea. Up to that point, you know, as W-2'd, I was, you know, odd jobs, and maybe I didn't even file taxes, but I started making real money. And what I realized within a couple of years was I didn't know enough. And so I'm hoping we're going to be able to give people kind of some answers to their questions, and you're going to be able to help them along pretty fast, at least so they know what they don't know. And let's go ahead and start. My first question is, and I think on everybody's mind, right, is what expenses can I deduct as a real estate agent? What do you see, Michael?
Well, there are several. The first and most common one is vehicle expenses. And there are two ways to deduct vehicle expenses. The first is to do actual expenses. The second is to take the standard mileage rate. The actual expenses is a bit more complicated, and it really only pays off if you have a high-end vehicle. I usually see people take the standard mileage rate, which is 70 cents per mile in 2025. So for example, if you put 10,000 miles in business mileage on your car, multiply that by 70 cents, that is a deduction of $7,000 off your income.
Got it. So, and that's 7,000 off your income. It's not like 7,000 off your tax bill, but $7,000 off your income when you're calculating what your taxes will be on what your taxable income is, I guess. Is that right?
Right.
Okay.
Another common expense is office expenses, and this comes in two flavors. Some people work from home, and in that case, you can take a home office deduction if you have a space that's used regularly and exclusively for a business. The second type is perhaps someone is renting a suite in an office building in a metro center, and certainly that's going to be deductible as well. The important thing to remember about the home office is it has to be regular and exclusive. I'll give you a quick story to demonstrate that. Many years ago, there was a gentleman who was running the business out of his home, and he got audited, and he wasn't home when the auditor showed up. His wife was home. He said, "Hi,
Uh-oh.
I'm from the IRS, and I'm here to help you." Right? So she said, "Oh yeah, come right in." He's like, and he said, "Can I see the home office?" And so he poked his head in for about 10 seconds, wrote something on a piece of paper, and left. And then he got a letter. He, the client, got a letter about a week later saying his home office deduction had been disallowed. And the reason for that is when the auditor went into the room, he noticed a box of toys and an ironing board in the corner. And he asked the wife, "What's that?" And she said, "Well, when my husband's not working in here, I do my ironing in here, and the toys are for the grandkids. The grandkids come over and they use this as a playroom too." So in the eyes of the IRS, that blew the quote regular and exclusive definition. So he can no longer take a home office deduction. So very important. If you're going to work from your home and you want to take the home office deduction, make sure you have a room set aside to use for business and nothing else.
Got it. You got a couple questions that came in, one on the mileage, and I was thinking the same thing. So a lot of us, you know, as a licensee, we office out of our homes now. What mileage is actually deductible? Is it deductible like if I go into the office to use a resource room to print some stuff off? Is that deductible, or is it only if I go to visit my client and show them homes? That's deductible. Do you know if there's
Yeah.
a distinction?
Yeah. The way the IRS looks at that is if you go from your home office to a job site, whether it's a home or the main broker office or what have you, they consider that commuting. So
Commuting. Okay.
so if it's 5 miles from your home to your office, that's commuting. Or 5 miles from your home to your first showing, that's commuting. Now, if you have several other stops you make that day, all the mileage between your first stop and your last stop is deductible. And
Oh,
then at the end of the day, when you make your last stop and you drive home, those miles are commuting again.
got it. So from your home to the first stop, nothing. From the first stop to the last, well, really second to, well, last stop is all deductible. But then from the last stop home, once again, not deductible. So that business stuff in the middle, deductible. Either if you go to the office first and then go to show a home, but it's from the office to the home, around to the other homes. And then the last home is the end of your tally. And then when you come back to your house, drive back, that's not. Okay. So between the first stop and the last stop, but not the commutes. Right.
That's absolutely right.
All right. Very good. And then a question about the home office too. We had come in. If you have a home office, but you don't include deductions, but you don't include it as a deduction, does it count as your? Oh, sorry, no, that was a different question. Excuse me, I had another one. Boy, they're moving fast. The questions are coming in. So, oh, I know what it is. So, and I think the answer is pretty clear. So with the car again, when you have a car, you can either do it two ways. You can take your total expenses and your percentage of that's allotted towards business, or you can do the mileage deduction, which is kind of a standardized way to say, well, it's probably what all your expenses really are as a standard deduction, right? You got to do one or the other. You can't do both. You can't take the standard deduction and then say, oh, I had oil change and I did it. You can't do that, right?
That's right.
Okay. All right. Just to make sure we're clear on that. So, all right. We got everybody, they're breaking it down. If you have a desk with a guest bed and good, it gets tricky. I think the real answer I heard about the home office is that with a home office, make sure it's being used as an office, right?
Mhm.
And you have to, yeah, because someday, it actually, it's kind of an interesting little thing that the IRS guy knocks on the door. It sounds like a start of some scam somewhere, but because I wouldn't let the guy in if it came to my house. But essentially the concept is right, which is if you're going to use it as a home office, then it needs to be an office and it needs to be used for work. And if you're going to try to take that deduction, you're going to need to make sure it sticks and it's real. And if it's a cross-use room, hard to do. Where do you draw the line, right? Okay. All right. All right. What other expenses should I deduct? Now, just for everybody to know, we're starting with expenses because these are kind of the fast, easy hitters. We're going to get into some stuff like should I be a sole proprietor or an LLC? How do I minimize self-employment taxes? We're going to ask a couple more questions as we go, but we're starting with some quick hitters here. What else? Any other expenses I can deduct as a real estate agent?
Yeah, certainly you can deduct your marketing and advertising. So your business cards, your costs for your flyers,
Mhm.
uh, y- your website, that's all deductible. Professional fees, such as licensing, continuing education, certainly your MLS fees and your association dues, those are all deductible. If you treat a client to a meal, essentially the client portion is deductible. Your portion is not. The IRS is going to assume that you're going to eat that day no matter what. But if you buy a meal for a client, that is deductible. If you give a gift to a client, whether it's a pen or a notepad or something, a water bottle, up to $25, that's deductible as a gift.
So super interesting. So you want to give a closing gift to somebody who just bought their house using you as a buyer's agent, and they just bought an $800,000 house, and you want to give them a gift, and you're like, yeah, it's a pretty smart business. I'm going to give them a really nice gift. They're going to remember me, and I can deduct the whole thing from my taxes. You're saying, nah, right? Like only $25 of it can be
The IRS rule is $25, yes.
Ah, okay. Okay. All right. That's good to know. What else should they be thinking about?
Um,
Any
well,
more
I,
questions?
I know there's a lot of questions about the mileage rate. Uh, just to put in a cap on that, actual expenses.
Yeah.
Uh, if you take 10,000 miles a year in your business, that's $7,000. If you were going to depreciate your vehicle, you would have to do it over 6 years, 5 or 6 years. So really, for the actual expense method to be worthwhile, you have to be talking about a vehicle that's over $40,000. If you're driving a vehicle
Because
that's,
you're gonna take the deduction over,
yeah,
was it 6 years?
yeah,
Yeah. So 40,000, 6 equal portions into 40,000 gets you close to the 7,000 you get if you're doing the miles, right? That's
yeah.
what you're looking at? Yeah, got it.
Mhm.
Got
Now,
it.
if you're just starting out and you're driving a vehicle that you paid 12,000 for, um, why would you take 12,000 in depreciation when you could take 40,000 in mileage? You know?
Yeah,
So
put
that,
on some miles and get 70
yeah.
cents a mile off your income. Yeah, right.
So that's the reason it's the more popular choice.
Got it. Got it. Yeah. In fact, I got to say, from everybody I know, they track their miles. Now, here's the other thing. I know back in the day when I started, you track miles. They're like, well, you got to have a notebook and you got to have, everything. And then it kind of became, well, it was a little bit harder to organize that. And you got to be very diligent. Do you suggest that people should use some of those new mileage tracking apps and stuff that are out there in order? I know we keep coming back to the car, but car seems to be a big thing here. Do you see some of those mileage tracking apps? Would you say, gosh, that's probably a smart idea? You're going to need to justify your miles if it comes down to an audit.
Yeah. I know earlier in the chat, someone asked, do we have to track mileage? And the answer is if you do, if you get audited.
Well, there you go.
You're gonna have to prove all those miles. Um, so it's best to have some kind of application.
Yeah,
Back when we were kids, this involved keeping a checkbook in the glove box, and you would manually write down your mileage on your odometer every time you made a stop. That was kind of a chore. So now today we have on our cell phones
yeah.
apps that are connected to a GPS that'll track all our mileage for us, and it's really made it a lot easier. And then at the end of the year, you just download your final number. Very
Yeah,
hassle-free.
very hassle-free and it's documented and it's straightforward. So, I would suggest if anybody is going to be putting on some significant miles in what you do, and there are some people that put on a lot of miles. They work in areas with vast coverage, but really even, moderate miles, every single penny. I mean, if I'm hiring some, like Michael, if I'm hiring you, right, I want to know all the advantages. So, and I was just going to cover one thing real quick. Some people look at it and say, gosh, you got to pay your fair share of taxes and you got to understand uh, the laws are already set up so you pay your fair share of taxes. And what we're going to talk about today is what the law says you need to do in order to do it properly, which also means the converse is true, which is it also means you don't have to do more than that and you don't have to pay more than that. And what is available to you? Our entire tax code is there in order to incentivize a certain behavior, and so it's up to us as professionals to understand what that behavior is, and people like Michael to help us understand what is available and isn't available. And I would like to just jump right to the next part, which is because there are some not only tax issues, but even the setting up of our entity, like how I'm going to operate. I think we have 39% of the people on here are still sitting in licensing classes. Good for you guys too, by the way. And I know we've got people in here been here for 10 years, and they still ask this question in their head because I still ask this question in my head, and I've been licensed for 33 years. And should I operate as a sole proprietor, an LLC, or S corp for tax purposes? I mean, if I had a dollar for every time I heard this question, but I'm thinking, Michael, you're going to be able to give us some real insight so that people can at least start their journey on what they think they should be doing.
Sure. When people are just starting out in their business and they're just getting their legs, Usually the easiest thing to do is set up a sole proprietorship.
Yeah.
And the reason that's the easiest is because it doesn't require a lot of paperwork. You don't have to hire a lawyer. You don't have to have a lot of filings with the authorities. You just basically say, I'm in business for myself. I'm going to report my earnings on my Schedule C and attach that to a 1040. Now, as you get more sophisticated and taxes start to become more of an issue and liability starts to become more of an issue, at that point, a lot of people will incorporate, meaning they'll form their own S corporation. And there's two main motives for that. The first is to distance themselves between any professional liability and their personal assets. And the second reason is to reduce self-employment tax. If
Hey,
you
can you give us just a little primer, because we're going to talk about self-employment tax a little bit deeper. Can you just give us what do you mean when you say self-employment tax?
Well, when we file our taxes at the end of the year, we all pay income tax. If we look at our W-2s or pay stubs, for example, we'll see three lines. The first is for income tax, the second is for Social Security, and the third is for Medicare. So when you're a W-2 employee, your employer does that for you. Now, when you're self-employed, when you're in business for yourself, you have to do that part yourself. So you have to take out Social Security and Medicare, and those combined are referred to as self-employment tax.
So Social Security and Medicare, you've got to take that out of your earnings, and because it's a flat percentage, right? Up to a certain amount of income.
It is, yes.
And then you got to pay that in because your employer hasn't done it for you already as a W-2. And believe me, 95% of you people in real estate are not employees. You are acting as an independent contractor, essentially for tax purposes. It's a non-employee independent contractor for tax purposes with your real estate companies. There are some companies out there who do hire you as employees, but for vast majority are not. So you're going to be responsible for your own taxes, and as a part of that, a big one, because it's there, it's always there, is what you call self-employment, which is Social Security and Medicaid. Okay, and what's the difference? Isn't there a difference between what you have to pay the whole sum for that too, don't you, when you're self-employed, as opposed to your employer paying part of it?
Yeah, that's absolutely right. When you're a W-2 employee, you'll see a deduction on your pay stub for 7.65%. That's what you're kicking in. That's what we all kick in to Social
Yeah.
Security and Medicare. What most people don't realize is behind the scenes, the employer is also kicking in another 7.65%.
Oh, okay.
So the total contribution is actually 15.3. And when you become self-employed, you're wearing both hats. You see both sides of the equation and you have to pay both sides. So SE tax is 15.3% of income, and that's over and above income tax. So
Got it. And that's over and above income tax. So just real quick, and then we're going to jump into this deeper LLC, S corp, right? Because I think you have some good info here. If I make $100,000 selling real estate, I got $100,000 worth of commissions earned. That's income. And if I don't have any other deductions or anything, it's $100,000. I'm going to owe 15.3% just as Social Security and Medicaid. So that 15.3% right off the, so $15,300 I better have set aside in order to pay that, correct?
that's right.
That's right. Okay. And then you're going to help us later to show us how to minimize that tax, that self-employment tax, in a little bit, right?
Mhm.
Okay. All right, very good. All right, so take us through sole proprietor. Most people, I think you said start as sole proprietor. I started as sole proprietor. I didn't really know any different at the time. When would you? What are the advantages of saying I'm not just a sole proprietor, I'm an LLC? I think you said there's some legal protections in there. Can you explain that a little bit more? Why it would be an LLC or an S corp, or maybe even like in the life cycle of an agent's career curve? Might they look at these differently as they go? Maybe you can help us with that.
Yeah. So there will probably come a point in everyone's career where they decide, I don't think I want to take all the liability myself, but at the same time, I'm not quite ready for an S corp. And that really is a good point to trigger an LLC. So an LLC is a state organized entity. It's exactly what it sounds like, a limited liability company. You can operate as a sole proprietor for tax purposes, but if you're doing everything under your LLC umbrella, now you also have the liability protection offered by your state. So if you're a sole proprietor in business and something goes wrong, they can come after your personal assets.
Oh,
Now, if you have an LLC between you and your clientele, they can only come out if anything goes wrong, heaven forbid, they can only come after the assets owned by your LLC. So your personal assets will be protected.
got it. Got it. So it's a state recognized entity, is that right?
Mhm.
And you can apply for it.
Mhm.
And you apply for the LLC, but for tax purposes, you get taxed as if you're a sole proprietor. But what it does is it puts an entity in there. Now, do you have to get paid differently then? Do you get paid, or do you have to get it paid to the LLC from your brokerage? How does that work?
Well, you'll want your LLC to be the payee,
Yeah.
at least on paper.
Yeah.
But if you're operating as a sole proprietorship, it's still going to end up on your personal 1040 under Schedule C.
Got it. All
So
right.
for federal tax purposes, the LLC is what they call a disregarded entity. To the IRS, you're still a sole proprietorship, but in court, if you're an LLC, you have all kinds of liability protection.
Okay. So when would I do an S corp?
I see people switch to an S corp when they start making real money. Uh,
What do you mean? What do you mean by real money? Like, how much is real
Real.
money in your head? Because
Well,
maybe it's a little different.
yeah. I mean, the answer is different for everybody. But just to give you a quick example, if I'm operating as a sole proprietor and I'm making, as you said earlier, 100,000 a year, well, if that's all subject to self-employment tax, gosh, I'm out $15,000 before I've done anything else. So if I'm making 100,000 a year, I'm going to say, you know what? I'm going to form an S corp. And if I were to give my job to somebody else, the going rate might be 50,000 a year. So I'm going to assign myself a salary of 50,000 a year. I'll still pay Social Security tax on that, but then I'll take the rest as a dividend. And the benefit of taking it as a dividend is I don't have to pay payroll tax on that anymore. So instead of paying Social Security on 100,000 a year, I'm only paying it on 50,000 a year. You can do that with an S corp.
Got it. And then so if I took 50,000 as a dividend, what is that? I don't even get taxed on that, or I do get taxed on that. At what rate though?
That'll be taxable at your ordinary income tax rate, whatever that turns out to be.
Okay.
So if you're in the 12% bracket uh, or the 22% bracket, it'll be taxed at that rate. Again, the difference is you won't have to pay that 15.3% on the dividend. So
Got it.
it's a significant tax savings.
Got it. So when you get sophisticated enough, I mean, I think what you've talked about here is just kind of a progression. Sole proprietor, it's easy. You don't really have to do anything. You just go to business, you use a social security number with your brokerage, and you start getting paid on commissions. There might be a way to help protect yourself as your business grows, going into an LLC. Gives you a little bit of a liability release in case something happens, goes wrong, with a client, with the property. There's somebody's injured, right, driving around in your car, whatever, right? The LLC can give you some of that protection. And then when you become a hitter, let's say, very sophisticated, you will be looking for an advanced tax strategies, which an S corp allows you more tools to do. Is that how you see it?
Absolutely.
Yeah, I probably just simplified 40 years of, education there. But that's really a kind of a way for us to look at it. So let me ask a question then. So if I'm how can anybody, because like I said, this self-employment tax, how would I minimize my self-employment tax, this 15.3%, other than, like you said about an S corp or LLC? Is there any other ways to minimize my self-employment taxes?
Yeah. Uh, the important thing to remember about self-employment tax is you want to keep it under control, but you don't necessarily want to get rid of it. The reason you don't want to get rid of it completely is because when you retire and it's time for you to get your Social Security checks or time for me to get my Social Security checks, they're going to say, well, how much did you pay in Social Security tax back in the day?
Um,
So if I paid nothing in Social Security tax, I would get no benefit
get
from Social
nothing.
Security. Uh, so it's not possible to make it go away completely. Uh, the first thing people often do is form an S corp for the reasons we talked about.
Mhm.
But if you're not ready for an S corp, the most important thing you can do is track your expenses. So set up a separate business account so you're not commingling funds and track everything. And then you can deduct that from your income and reduce your SE tax. And I'm not suggesting you should go out and spend money you wouldn't ordinarily spend.
You're still spending money.
Yeah, that would be self-defeating. But if you're going to spend the money anyway, no matter what, for heaven's sake, make sure you claim it as a deduction so you're not paying more than you have to.
Yeah. Keeping track of your expenses, having a process in which to do that. I mean, I know we have a business credit card, so it's easy. Everything we do on the business is done on that credit card. It's all there. It's a simple report, it categorizes it for us for our taxes. Very straightforward. Finding a process by which you can always track all of your expenses, I think is what I heard out of there. Because like we talked about earlier, you have income of $100,000, and then you get some deductions off of that, and part of it is your expenses. And so, if you had $30,000 in expenses, be it marketing, be it mileage in your car, be it taking people out to lunch, can't get your lunch covered, but you get their lunch covered, right? Doing those deductions, you might take $30,000 off of the top of that $100,000 of income. And now you're only going to be taxed, self-employment tax on 15.3% of $70,000 as opposed to $100,000. That's what you're saying, right? Find those, keep track of those taxes and those expenses and deductions.
Mhm.
What records do I got to keep for that?
Yeah. Well, certainly you want to keep a mileage log, and a lot of apps on cell phones today will do that for you. Uh, the best way when tax time rolls around to present your expenses to your tax professional is to give them a spreadsheet. So you can download this activity from your bank account or your credit card or what have you. And that's why it's so important to have a separate account. You don't want to commingle funds. You don't want to have to pay an accountant $100 an hour to sift through your expenses and decide what's business and what's personal. Set up that separate account. So a spreadsheet, mileage log, uh, that, uh, and going beyond, you're talking about receipts, maybe credit card statements, certainly your commission statements, your meal records, marketing and advertising costs, and certainly your education costs.
Got it. Nice. All right, let's move in. We're cruising along. We're 30 minutes in. So, what should I know about handling my commissions? Right. So, let me just I'll tell a little story about myself. I had been a W-2 employee before coming into real estate, and all of a sudden I got my first commission, and it was the whole commission. It was a big fat check, and I was like, woohoo. And everybody said, hey, you got to be careful, right? You might want to understand what you're doing with that, because you're probably going to have some tax consequence out of that money later. And I'm like, yeah, we'll catch up with that later. I didn't really understand what it meant to be responsible for my own taxes, because now I became a 1099 income person. What should I know about handling commissions and 1099 income?
Yeah, I think in a way you've already said it. When you're a W-2 employee, your employer will do all that for you. When you're a 1099 independent contractor, you're in business for yourself. So you have to start handling your own taxes. In the United States, we're on a pay-as-you-go system. So if you wait until the end of the year or April 15th to pay your taxes, IRS is not going to like that. They're going to charge you a failure to withhold penalty. And not only will they not like it, you probably won't like it either because you're going to have to come up with a big wad of cash every April 15th. And sometimes that's easy and sometimes it's not. So a better way to go is to make quarterly estimated payments. Generally, I recommend folks set aside at least 25 cents on the dollar of their commissions. So if you make a good sale, you have a $10,000 commission check, immediately put $2,500 into a savings account. Because you got to figure 15.3% for self-employment tax, and you have to figure you're going to be at least in the 10% bracket. That's the lowest bracket. So protect yourself from a big hit at the end by putting aside 25 cents on the dollar for taxes. Send them in quarterly to the IRS. You can do a paper check or you can do it online, and that'll keep you out of harm's way.
Boy, wiser words have never said. I'm going to unpack that a little bit because one of the largest personal checks I ever wrote was because of this. And that was because I did not set aside my tax money when I first started in real estate. I thought, well, I got this money, I got expenses, I got to get a better car, I got to get better clothes. I did all this stuff. And so I made a lot of money my first year in real estate, and I didn't set aside for taxes. So come tax day, I do my taxes, and I'm whoa, I'm $38,000 light. I mean, I was like, I didn't have it, and so I did the wrong thing. I hid from it, and I didn't file, and that was wrong. It was bad because you know what? It catches up with you. And in 2 years, you keep thinking you're going to make up for it. You're going to get ahead of it, and I just make one more sale, and it didn't work. I wish somebody would have told me to make sure you set aside your tax amount and don't touch it. You don't want to be behind, because there was a time when there I was sitting in front of the tax man, and it was an $86,238 check I had to write, and that was with the taxes and penalties and everything. And so, do not fall into the trap of not preparing for your taxes. That's why it's a lot of money. And if you don't really understand the rules, like I didn't understand the rules, I didn't understand how I could write everything off. I thought I did. I was a smart guy, but you know what? I was good at real estate. I wasn't good at taxes. And there's a reason why there's people like you, right, with these CFP designations and tax designations. And so handle your commissions properly and set aside for taxes, because they will come due at some point. And then it's trouble. That's trouble. All right. Are there any tax credits or incentives, like just as a real estate professional? Because I think there are some real tax advantages as a real estate professional, kind of carved out of the tax code that says, oh, taxes work like this unless you're a real estate professional. There's some special things. What do we got to be as a real estate professional? What are we looking at?
Yeah, sure. Well, when Congress passed the Tax Cuts and Jobs Act of 2017, they created what's called the Qualified Business Income Deduction. So the simplest way to explain that is they were giving tax breaks to big businesses, big corporations. And I'd like to imagine somebody raised their hand and said, well, what about the little guy? What about the independent contractors working hard out there every day? So Congress gave us the Qualified Business Income Deduction. It's essentially a 20% tax break on your business earnings. So it's a very complex calculation. I don't want to oversimplify it, but essentially, if you have 100,000 in business earnings, you get to exclude 20,000 right off the top, 20%. So that's
of the income earnings.
Yeah.
Okay.
So, and that's not excluded from self-employment tax, but it is from income tax. So that's a big one.
Okay.
Certain
And how does that, do I have to have an S corp to do that? Do I have to have an LLC, or can I do that as a sole proprietor?
You can do it as either an S corp or a sole proprietor.
Okay, so as an S corp or a sole proprietor, right? Because well, LLC is not a taxed entity, so, or tax recognized entity. So as a sole proprietor, S corp, and so if I'm going to take this $20,000 deduction, is that in addition to like the standard deduction on my taxes? How does that
Yeah.
work?
Yeah, that's the great part. So the standard deduction protects income in general. The
Okay,
QBI deduction is designed to protect business income. So you
okay.
can take both.
You can take both. All right. So, but how does the IRS identify if I truly am a real estate professional? Is there like a guideline like you have to do like, like in order to be considered a resident of a state, you have to be there like 6 months and a day of that state. How do they identify if you're real estate? Is it based on how hard you work, how many miles you put on your car, how many sales you have, or what is it based on? Do you know?
Yeah, so the first thing to look at is if you spend the majority of your time in real estate activities.
Okay.
If you have a 9 to 5 at a retail store, and then you kind of just do real estate on the side,
Yeah, yeah, yeah.
they're not going to consider you a real estate professional, even if you have income. So if more than half of your work hours are in real estate, then you're a real estate professional. The other test they're going to look at is the 750-hour test,
Oh,
meaning if we only went by the first test, you could have, for example, a retiree spend 10 hours 1 year selling a home and then do nothing the rest of the year. And he could say, well, I'm a real estate professional. And
yeah. What I do. Yeah.
the IRS will say, no, you're not. And he say, well, yeah, I spent more than half my work hours on real estate activities.
Uh,
And they would say, well, yeah, but did you spend at least 750 hours in real estate activities? If the answer is yes, then yeah, you can call yourself a real estate professional, at least for tax purposes.
yeah. So you got to you have to solve for both. You have to say it has to be more than 50% and it has to be at least 750 hours, right?
Yeah, for tax purposes, yeah.
For tax purposes. Got it. So like I'm a full-time employee at Kaplan, that's what I do, but I do have a real estate license and I do several deals a year for friends and my own stuff. Uh, and I'd like to be I'd like to be a real estate professional, but I don't do 750 hours at it. So I wouldn't qualify. And okay, got it.
Yeah. So the real benefit of being a real estate professional, as you get more established in your career, and a lot of real estate guys will acquire rental properties. If you're just an average person with a rental property, it's passive income. If you're a real estate professional, it's active income, and you can take much bigger deductions. So
Uh,
that's down the road. That's pretty advanced stuff, but it's
yeah.
important to know if you're going to be in this career for any length of time.
Yeah, and that is a big part of it too. I think if I could just reiterate what Michael said, one of the most beautiful carve-outs and benefits of being a real estate agent is you get to know a marketplace, you get to understand value very fast. And I think about this all the time, even my own career where I invested money, I invested in real estate because I knew it. I didn't invest a lot in the stock market, and I have 401k and all. I got to let somebody else do that. But when I wanted to really focus my money, I focused on something I knew, which is real estate, and bought investment properties. And so the advantage, like you're talking about, there is a carve out. There is a tax advantage for active income if you're a real estate professional and you have investment properties. There is what you said, what is accelerated depreciation that you can take as a real estate professional. And what that means is you can have income on your property, but you can accelerate, what is it, 27 and a half year depreciation table and go faster and take that depreciation against your income and make it look like the property has zero cash flow. And you can do that over and over until a point, but then it can even become even more sophisticated. And then I think we're into a whole nother class, which is like 1031 exchanges of like kind property and deferring taxes even longer. There's a whole sophisticated retirement plan in play for a real estate professional. And that's a whole nother conversation. Am I right? Did I get that right, Michael?
Yeah, I'd say for the most part, that's on target.
Yeah.
Yeah, it's important that you mention a 401k.
Yeah.
When you're in business for yourself as a real estate professional, don't forget, you can set up a 401k, you can set up your own health insurance. This is all deductible against your income tax. So it's a
Mm.
great way to save money and prepare for the future.
Sure, you drop your money into 401k, whatever goes in there, it comes off of your, reduces your taxable income for that year, correct? I mean, you are kind of, depending on what you invested in, you're kind of kicking the can down the road if it's 401k, but that's okay. All right, so let's do this. What strategies can I use to reduce my taxable income? I think we covered some of those. Is there anything else?
Yeah, certainly when you're self-employed, you can take the self-employed health insurance deduction. So your premiums become deductible from income tax if you're self-employed. Most of us would have to put that on Schedule A, but since you're self-employed, you can put that as an adjustment on your 1040. What it boils down to is your health insurance premiums will save you
Are
money on taxes.
got
Uh,
it.
Certainly, you want to set up a health savings account. That goes in tax-free. If you use it for medical expenses, it comes out tax-free. Even something as simple as eyeglasses. You can set up a solo 401k, or if you're not ready for that, you can set up a traditional IRA. These things will all reduce your taxable income.
Got it. Got it. Okay, so a couple of important things there. And here's the deal. We're coming down. We got a couple minutes left. Michael is available on our forum. I think Jamie Cash is going to put in the chat kind of how we can continue this conversation. If you have more questions, I saw some specific ones come by. I purposely didn't answer. I saw your questions, everybody, but some of them would take us down a little a little spiral down into Never Never Land that we just don't have time for. But this is an idea to let you know a couple golden nuggets that you can get out of this session today. And so, any other kind of closing thoughts, Michael? Any other closing, bits of information or nuggets that people should understand before we end today?
Yeah, I think Jamie mentioned this in the chat, but probably the most important thing you can do when you're starting out is work with a tax professional.
Yeah.
Do not try this at home.
Yeah. Right.
I know a lot of people that will try to use home-based tax software themselves. And in all fairness, the stuff is good. I mean, it's a good product. But if you don't have any training, it's a lot like handing somebody the keys to an F-16.
Yeah.
Here you go.
Yeah. It's a beautiful machine, but do you really know how to make it all operate?
Yeah. Yeah. And if you don't know how to make it operate, there's a good chance you're going to crash and burn.
Yeah.
So believe me, when I say it's well worth your time and money to talk to a tax professional, they'll do all the heavy lifting. Especially if you're a new agent, they'll make sure you're getting all the deductions you should. And in the end, you'll thank them.
I don't think there could be better advice. Talking to a tax professional about what it means, about what you got to do, super important to talk to a tax professional for that. And if your tax professional doesn't do it, like there's a lot of people out there who prepare people's taxes, but they don't really give any advice. They just prepare the taxes. You're going to want to make sure you're talking to somebody who actually is preparing taxes and preparing your business for the kind of deductions that you need. Going on, but I want to thank you, Michael, for being here. I know this is a huge topic. I know we just kind of skimmed across the top of the water a little bit, but I think we brought some really insightful nuggets to people. And once again, everybody, you can continue this conversation on the public forum that's out there at Kaplan. If you want to continue this conversation, Michael will cover the questions for you and make sure that we get you pointed in the right direction, because I know some of you had some very specific things for us. So please, everybody, go to the forum. You can ask your questions. It's up on the page right now, and I think Jamie Cash put it in the chat. And thank you all. Thank you, Michael, and we'll talk again soon.
Well, it's been an honor. Thank you so much, and many happy returns, everyone.